The sound you hear in the distance, that low hum of anxiety that settles over the financial news every few months, is the sound of an approaching storm. It's a feeling every person who has ever put a dollar into the stock market knows intimately. The fear that the numbers on the screen, which represent years of your work, your savings, your discipline, could be cut in half in a matter of weeks. The market is going to crash. It's not a question of if, but when. And for 99% of investors, this event will be a catastrophe, a complete wipeout of their progress toward financial freedom. Their portfolios are built on a single fragile assumption, that the good times will keep rolling. They are ships built for a calm sea, and they have no idea the hurricane is just over the horizon. But a stock market crash does not have to be a catastrophe. For a select few, for those who understand the deeper architecture of wealth preservation, a recession is not a threat, it is an opportunity. It is the single greatest moment to transfer wealth from the unprepared to the prepared. This is not about timing the market. It is about building a fortress, an all-weather portfolio so resilient, so intelligently designed, that it doesn't just survive the storm, it harnesses its power. The secret lies in a principle that Warren Buffett has used for over half a century to not only protect Berkshire Hathaway's capital, but to aggressively expand it during times of maximum fear. The principle is the strategic acquisition of non-correlated assets. This is a simple phrase for a profound idea: owning businesses whose success is fundamentally disconnected from the manic depressive cycles of the overall economy. While others are praying for a bull market, you will be constructing a portfolio where a significant portion of your assets simply doesn't care if there's a recession. The costly mistake this prevents is the single most common reason for financial ruin. Building a portfolio where every single stock, from tech to banking to retail, is tethered to the same economic life support system. When that system gets sick, everything collapses in unison. There is no safe harbor, there is no anchor, there is only the abyss. The financial transformation you are about to undergo is the mastery of this principle. You will learn to see the market not as a monolithic entity, but as a collection of individual businesses, some of which march to the beat of a different drum. You will learn to identify and analyze companies, like candy makers whose sales are driven by holidays, not housing starts, or auto insurers who collect premiums whether their customers have jobs or not. This is the art and science of defensive investing, the key to true portfolio diversification, and the only reliable path to beating the market over the long term. This is how you build a portfolio that lets you sleep soundly through the inevitable panic, knowing that your foundation is made of rock, not sand. Our journey into constructing this financial fortress begins with the most intuitive yet most powerful pillar of them all, the fortress of inelastic demand. This is the bedrock of recession-proof stocks. The concept is elegantly simple. Inelastic demand refers to a situation where the quantity of a good or service demanded by consumers does not change significantly when its price changes, or, more importantly for our purposes, when the consumer's income changes. These are the things people buy because they have to, or because the emotional or habitual pull is so strong that the purchase becomes a non-negotiable part of their lives, regardless of the economic weather. It's the difference between a want and a need, but it's also more subtle than that. It's the difference between a discretionary luxury and an affordable essential ritual. To truly understand the immense power of this concept, we must travel back to 1972, to a decision that would fundamentally alter Warren Buffett and Charlie Munger's entire approach to wealth management and capital allocation. This is the story of See's Candies. The foundational anecdote that unlocks this entire pillar begins not with a spreadsheet, but with a box of chocolates. In the early 1970s, Berkshire Hathaway was still transitioning from a dying textile mill into the investment vehicle it is today. Buffett and Munger were hunting for businesses, but they were still largely trained in the cigar-butt school of investing championed by Benjamin Graham, buying mediocre businesses at dirt-cheap prices. They were looking for statistical bargains. Then, a man named Robert Flaherty from Blue Chip Stamps, a company Buffett and Munger controlled, brought them a deal. It was a family-owned candy company based in California called See's Famous Old Time Candies. The C family wanted to sell. The asking price was $30 million. Buffett and Munger took a look. The company was good. It was very good. It had a fiercely loyal customer base in California. It produced high-quality chocolates and sold them through its own retail stores. The financials were solid. The business earned about $2 million after tax. A $30 million price tag meant a price-to-earnings ratio of 15. For disciples of Ben Graham, who preached never paying more than a low single-digit multiple for a business, this was heresy. It was expensive. Their initial reaction, as Munger would later recount, was to dismiss it out of hand. But something about C's kept nagging at them. They dug deeper. They saw a business that required very little capital to operate. It had a float from its gift certificate program. But most importantly, it had something intangible, something that didn't show up on the balance sheet. It had a brand that was lodged deep in the hearts and minds of its customers. People didn't just buy C's candy. They gave it as a gift for Valentine's Day, for Christmas, for birthdays. It was part of family traditions. A young man courting a woman in California would bring her a box of C's, not Russell Stover. Taking a box of C's to a dinner party was a sign of good taste. This wasn't just a commodity. It was an emotional transaction. They realized that this emotional bond gave C's incredible pricing power. They could raise their prices by 10% every year, covering inflation and then some, and not a single customer would defect to a cheaper brand. The extra 10 cents on a pound of chocolates was an insignificant price to pay to avoid the social embarrassment of showing up with the wrong box of candy. This was the epiphany. This was inelastic demand in its purest form. They negotiated the price down to $25 million, a figure that still felt rich to their Graham-trained minds. They pulled the trigger, they bought it. And that single $25 million decision changed everything. Over the years, C's Candies became what Buffett called the prototype of a dream business. It required minimal additional capital investment, and it gushed cash. By the early 2000s, that little candy company they bought for $25 million had generated over $1 billion in pre-tax earnings for Berkshire Hathaway, all of which was sent to Omaha to be reinvested in other assets. It became the financial engine that funded countless other acquisitions. It was the gusher of capital that bought parts of Coca-Cola, American Express, and the Washington Post. C's taught Buffett and Munger that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The wonderful quality they had discovered was the fortress of a brand that commanded inelastic demand. Through the recession of the mid-1970s, the downturn of the early 80s, the dot-com bust, the 9/11 shock, and the 2008 financial crisis, people in California kept buying C's Candies. They might have delayed buying a new car, they might have canceled a vacation, but they did not stop giving that 1-pound box of chocolates on Mother's Day. That $25 million investment was not just a successful example of stock picking. It was a multi-billion-dollar education in the psychology of the consumer and the true nature of an all-weather portfolio. The magic of C's Candies isn't just about good chocolate. It's a masterclass in the underlying psychological principles that create indestructible businesses. At its core, Buffett stumbled upon the powerful combination of habit formation and emotional branding. These two forces work together to take a simple product and embed it so deeply into a consumer's life that it becomes immune to the rational cost-benefit analysis that governs most purchasing decisions during a recession. Let's first deconstruct habit formation. Our brains are fundamentally lazy. They are designed to conserve energy by creating cognitive shortcuts. When we find a product that solves a problem satisfactorily, we tend to stop searching for alternatives and lock that choice into a repeatable routine. This is known as the default effect. For millions of Americans, Colgate is the default toothpaste. Heinz is the default ketchup. Coca-Cola is the default soft drink. The act of choosing a competitor requires conscious effort, a break from routine, and the introduction of risk. What if the other brand isn't as good? During times of economic stress and uncertainty, people cling to routines and familiar comforts more than ever. The world outside might be chaotic. but the small, predictable rituals of daily life provide a sense of stability. The brand of coffee you drink every morning, the brand of soap you use, the small treat you allow yourself, these are not just products, they are anchors. A company with a product embedded in a daily or weekly habit has created a powerful psychological moat that a recession can barely touch. Their revenue stream isn't based on a series of individual rational decisions. It's based on millions of automated subconscious actions repeated day after day. This is a critical insight for anyone looking for recession-proof stocks as part of their risk management strategy. Now let's layer on the even more potent force of emotional branding. See's Candies is the perfect example. See's doesn't sell chocolate. It sells nostalgia, affection, and tradition. When you give a box of See's, you are communicating love, gratitude, or apology. The candy is merely the physical vessel for the emotion. This is a profound distinction. During a recession, people cut spending on asterisk things. They are far less likely to cut spending on asterisk relationships and emotions. They will slash the budget for a new television, a discretionary thing, damas, but they will not slash the budget for the Valentine's Day gift that communicates affection to their partner. Because See's has so effectively tied its brand to these powerful emotional moments, the $20 price of a box of candy is not compared to the price of other candy. It's compared to the perceived value of the emotional message it sends. In that context, it's an incredible bargain. This is why companies like Disney, Hershey's, and even Coca-Cola, with its Share a Coke campaigns, invest billions in associating their products with happiness, family, and togetherness. They are not just building market share, they are building a psychological fortress against economic downturns. They are moving their product from the discretionary spending column in a consumer's mental ledger to the emotional necessity column. This is a form of portfolio diversification at the deepest level, diversifying away from the logic of economics and into the enduring logic of human psychology. So how do you, as an investor aiming for financial freedom, translate this theory into a practical, repeatable process? How do you build the blueprint for finding these fortresses of inelastic demand? It's a mental model that requires you to stop thinking like a stock market analyst and start thinking like a cultural anthropologist and a psychologist. Here is the step-by-step process for applying this to your own stock picking. Step 1. Begin with an audit of your own life. This is the most honest data you will ever find. For 1 month, track every single dollar you spend. Better yet, pull up your last 3 credit card statements. Ignore the big one-off purchases. Look for the small, recurring charges. What brands do you buy over and over again without thinking? The brand of razor blades, the coffee, the pet food, the cleaning supplies, the specific brand of beer you drink on a Friday night. These are your personal inelastic goods. Now, ask yourself, if your income were cut by 30% tomorrow, which of these purchases would you not give up? The list that remains is your starting point for research. These are companies that have successfully embedded themselves into your life as a habit. Step 2. Hunt for toll booth businesses. A toll booth business is one that owns a product or service that is a small but necessary component of a larger, more expensive activity. Think of the companies that make the little valves that go into every air conditioner, or the specific adhesive used in every smartphone. The cost of their product is so minuscule compared to the final product's cost that the manufacturer would never risk switching to a cheaper, unproven supplier to save a few pennies. They have immense pricing power because their price is almost irrelevant to the end user. Another example is the software that dominates a specific niche, like Adobe in creative industries, or Intuit's QuickBooks for small business accounting. The subscription cost is a tiny fraction of a business's overall expenses, but the cost of switching, in terms of retraining, data migration, and potential disruption, is enormous. Therefore, they can raise prices year after year, and their customers will begrudgingly pay. This is a key element of defensive investing. Step 3. Apply the Buffett pricing power test. This is a simple but powerful thought experiment. For any company you are analyzing, ask yourself, could this company raise the price of its core product by 10% tomorrow, and would they lose any significant number of customers? If the answer is yes, they have no moat. If the answer is no, you have found something special. A company like Coca-Cola can raise the price of a can of Coke by a nickel, and it will have zero impact on their volume. A generic cola brand cannot. A company like Apple can raise the price of the iPhone by $50, and the launch day lines will still be around the block. A competing Android maker trying the same thing would see its sales collapse. This pricing power is the direct financial manifestation of an inelastic demand fortress. Step 4. Examine the marketing-to-revenue ratio. Companies with true inelastic demand don't need to shout to be heard. Their product or brand sells itself through habit and reputation. Look at a company's financial statements. A business that has to spend a huge percentage of its revenue on sales and marketing just to maintain its position is in a constant, grinding battle for relevance. A business with a powerful brand, like Hershey's or a dominant utility, has a much lower marketing spend relative to its sales. Their customer acquisition cost is low because their customers are already locked in. This financial signature is a clear indicator that the demand is real, durable, and not artificially propped up by expensive advertising. By following this 4-step mental model, you shift your focus from speculative growth to proven durability, a cornerstone of effective wealth preservation and the construction of a true all-weather portfolio. Now, to fully appreciate the genius of this approach, we must shine a harsh light on its opposite, the antithesis, the path walked by 99% of market participants. This is the path of chasing elastic demand, and it is a guaranteed recipe for catastrophic losses during a stock market crash. The 99% build portfolios that are exquisitely sensitive to the economic cycle. They fall in love with companies whose success depends entirely on a booming economy and confident, free-spending consumers. Think about the darlings of a bull market. They are almost always producers of highly discretionary, high-ticket items. Luxury automakers like Ferrari, high-end fashion brands like LVMH, cruise line operators like Carnival, and airlines like Delta. These businesses are spectacular wealth creators when credit is cheap and everyone feels rich. But their demand is hyper-elastic. The moment a recession hits and layoffs begin, the first things to be cut from the family budget are the $1,000 handbag, the vacation to the Caribbean, the business-class flight, and the down payment on a new luxury SUV. The demand for these products doesn't just dip, it falls off a cliff. Another siren song for the 99% is the speculative high-growth technology sector. They invest in companies that are often unprofitable, fueled by the promise of future dominance. These companies are selling a story, a dream of a new paradigm. But this dream is funded by cheap venture capital and a buoyant IPO market. In a recession, the capital markets freeze. The narrative of growth at any cost is replaced by a brutal demand for profitability now. Companies that are burning cash suddenly find their lifeblood cut off. Their stock prices collapse not by 20 or 30%, but by 80 or 90%, as investors realize the dream is unsustainable without a constant infusion of new money. The dot-com bust of 2000 is the ultimate case study. Investors piled into any company with .com in its name, ignoring balance sheets, profits, or any semblance of a durable business model. They believed a new era had dawned where traditional valuation metrics no longer applied. When the recession hit in 2001, these companies, built on nothing but hype and elastic advertiser demand, evaporated. The Nasdaq index fell nearly 80%, wiping out trillions in speculative wealth. The portfolios of those who followed the herd were decimated. It was a brutal lesson in the difference between a fleeting story and a durable business. The path of the 99% is psychologically seductive. It feels exciting to be invested in the future, in the companies everyone is talking about. It offers the thrill of rapid capital gains. But it is an approach devoid of risk management. It mistakes a bull market for genius. And it builds a portfolio that is a ticking time bomb, perfectly synchronized to explode during the next economic downturn. The final, critical piece of this pillar is understanding the direct financial connection. How does this principle of inelastic demand translate into cold, hard numbers on a balance sheet and in your brokerage account? The difference is not subtle. It is a chasm that separates wealth preservation from wealth destruction. First, let's look at the income statement. A company with inelastic demand, like a utility, a consumer staple like Procter & Gamble, or a dominant brand like See's Candies, will exhibit remarkably stable revenue streams through a recession. Look at their quarterly sales figures during the 2008 crisis or the 2020 pandemic. You will see a small dip, or in some cases, even a slight increase. But you will not see the 50% revenue collapse experienced by cyclical companies like airlines or automakers. This top-line stability flows directly down the income statement. Because revenues are stable, earnings and, most importantly, free cash flow remain predictable. Free cash flow is the lifeblood of any business. It's the actual cash left over after all expenses and investments are paid. It's what's used to pay dividends, buy back stock, and make acquisitions. A company that continues to generate strong free cash flow during a recession is a king in a world of paupers. Now, let's connect this to your portfolio. This financial stability creates two powerful advantages. The first is downside protection. When the market panics, investors flee from uncertainty to certainty. They sell the speculative, unprofitable growth stocks and pile into the reliable, cash-generating businesses. As a result, the stocks of companies with inelastic demand fall far less than the overall market. They act as a sea anchor, dramatically reducing your portfolio's volatility and drawdown. This is the essence of wealth preservation. While your neighbor's portfolio is down 40%, yours might only be down 10% or 15%. This is not just a mathematical advantage, it's a psychological one. It prevents you from panic selling at the bottom. The second advantage is the power of dividends. Many of these durable companies are mature businesses that pay a significant and growing dividend. During a recession, when stock prices are falling and capital gains are non-existent, that quarterly dividend check becomes an incredibly valuable source of return and liquidity. It's cash in your pocket that can be used to cover living expenses or, even better, be reinvested into the market at bargain basement prices. You are being paid to wait for the storm to pass. For entrepreneurs watching this, the lesson is equally profound. Building a business with a recurring, habitual revenue model, like a subscription service for an essential product, is infinitely more valuable and resilient than a business built on one-off, cyclical transactions. It creates a company that can not only survive a downturn but has the financial strength to acquire weaker competitors who are struggling. This focus on inelastic demand isn't just a stock market trick. It's a fundamental principle of building enduring business value and the first, most important block in your all-weather portfolio. Having established the fortress of consumer demand, we now turn to the second great pillar of a recession-proof portfolio, the ironclad balance sheet. If inelastic demand is the shield that deflects the blows of a recession, the ironclad balance sheet is the fortress's deep, well-stocked larder and its towering, unbreachable walls. It is the ultimate non-correlated asset because its strength is internal. A company with a mountain of cash and little to no debt does not need a healthy economy, functioning credit markets, or forgiving bankers to survive. It is its own sovereign financial entity. Its fate is in its own hands. This principle moves beyond what a company sells and focuses on how it is financed. It is the profound understanding that in the depths of a crisis, it is not the cleverest business model that survives, but the most solvent one. Liquidity becomes the only thing that matters. And for the investor who understands this, it provides not only safety but a weapon of incredible power. To grasp the offensive capability of a strong balance sheet, we must revisit the darkest days of modern financial history, the fall of 2008. The entire global financial system was on the verge of collapse. A stock market crash of epic proportions was underway, and credit had completely frozen. No one was lending to anyone. Fear was absolute. It was a moment of unprecedented crisis. And for Warren Buffett, it was the greatest opportunity of his lifetime. The foundational anecdote for this pillar is not a single, quiet acquisition like See's Candies, but a series of audacious high-stakes maneuvers that could only be executed by someone commanding a financial fortress. In mid-September 2008, Lehman Brothers had just collapsed, sending shockwaves through the global financial system. Panic was rampant. The titans of Wall Street, who weeks before had been the masters of the universe, were now on their knees, desperate for capital to shore up their hemorrhaging balance sheets. Their own colossal leverage, which had generated record profits in the boom years, had now become a fatal liability. On September 23, 2008, the phone rang in Omaha, Nebraska. It was the CEO of Goldman Sachs, one of the most prestigious investment banks in the world. They were facing a crisis of confidence. They needed capital, and they needed the ultimate stamp of approval to signal to the world that they were solvent. They needed Warren Buffett. Buffett, sitting on tens of billions of dollars of cash within Berkshire Hathaway, was not in a state of panic. He was in a state of readiness. He listened to their proposal and made a counteroffer, on terms so good they were almost unbelievable. He would invest $5 billion in Goldman Sachs. But this wasn't just a simple stock purchase. He bought $5 billion of preferred stock that paid him a guaranteed 10% dividend per year. That's $500 million in cash, paid to Berkshire every year, like clockwork. On top of that, he received warrants giving him the right to buy another $5 billion of common stock at a fixed price of $115 per share for the next 5 years. He was being paid handsomely to wait, with a massive upside if the company survived and recovered. It was a lifeline for Goldman, but it was a masterstroke of predatory investing for Buffett. He was acting as a private Federal Reserve, providing liquidity to the system on his own terms. Weeks later, in early October, another giant came calling. General Electric, a bedrock of American industry. They too were struggling to fund their massive financing arm, GE Capital. Buffett struck a similar deal. He invested $3 billion in GE preferred stock, also paying a 10% dividend, and received warrants for another $3 billion in common stock. These were not investments made out of charity. They were the direct result of decades of disciplined financial management. For years during the bull market, Buffett had been criticized for holding too much cash, for being too conservative, for missing out on the high-flying returns of the tech and housing booms. He looked like an old man who had lost his touch. But Buffett wasn't focused on maximizing returns in the ninth inning of a bull market. He was preparing for the inevitable downturn. He knew that in a crisis, cash is king. More than that, he knew that cash combined with courage in a time of fear is priceless. When everyone else was forced to sell assets at any price just to stay alive, Buffett was the only one with the capital and the nerve to buy. His ironclad balance sheet was not a defensive tool. It was an offensive weapon. Berkshire Hathaway became the lender of last resort to corporate America, and in doing so, secured profits of more than $10 billion from these crisis-era deals. This episode is the ultimate illustration of the principle. A strong balance sheet provides the power to turn a systemic crisis, a moment of maximum risk for the 99%, into a generational opportunity for wealth creation. The psychological chasm between Warren Buffett's actions in 2008 and the behavior of the average investor is vast, and it is rooted in two powerful cognitive biases: recency bias and survival bias. Understanding these biases is crucial to developing the temperament required for superior risk management. Recency bias is our tendency to give greater importance to recent events than to historical ones. During a long bull market, like the one that preceded 2008, investors become conditioned to a certain reality. They see stocks only going up, credit remaining cheap and plentiful, and corporate growth continuing unabated. Their brains extrapolate this recent past into the indefinite future. The memory of past crashes, 1929, 1987, 2000, fades. It becomes an abstract historical event, something that happened to other people in a different era. Warnings of excessive leverage or frothy valuations are dismissed as old-fashioned pessimism. The investor's mind becomes convinced that, quote, "this time is different." They see companies taking on massive debt to fund share buybacks or ambitious acquisitions, and they reward them with higher stock prices, viewing the leverage not as a risk but as a sign of aggressive, shareholder-friendly management. Buffett operates on the exact opposite principle. He is governed by a deep sense of financial history. He knows that credit cycles are as old as capitalism itself. He operates with a paranoid assumption that the market could be shut down tomorrow and credit could evaporate without warning. This is why he always insists on maintaining a fortress balance sheet at Berkshire, with a massive cash hoard that he views as an insurance policy. He is actively fighting recency bias by constantly reminding himself of the lessons of history. The second bias at play is survival bias. We look at the successful companies around us and tend to forget about the thousands that failed along the way. In a bull market, we see leveraged companies growing quickly, and we admire their boldness. We don't see the graveyard of companies from previous cycles that used the exact same strategy and were wiped out when the tide went out. This creates a distorted view of risk. It makes leverage look like a brilliant tool for accelerating capital gains, because the only companies left to observe are the ones that, so far, have survived using it. The average investor looks at a highly leveraged company and sees only the upside. Buffett looks at the same company and sees the ghost of Lehman Brothers or Bear Stearns. He understands that leverage is a double-edged sword that magnifies gains on the way up but guarantees bankruptcy on the way down. The psychological pain of being a forced seller during a crash is immense. It forces you to liquidate your best assets at the worst possible prices. Conversely, the psychological power of being a discretionary buyer with a mountain of cash is immeasurable. It allows you to remain rational, calm, and opportunistic while the world is consumed by panic. Buffett's 2008 performance was not just a financial victory, it was a psychological one. He had spent decades conditioning himself to be greedy when others are fearful, and his ironclad balance sheet was the tool that made acting on that conviction possible. So how do we translate Buffett's institutional-grade financial discipline into an applied mental model for the individual investor? How do you build your own blueprint for identifying companies with ironclad balance sheets? It requires a deliberate shift away from the income statement, which tells you how a company is performing right now, to the balance sheet, which tells you how it will survive a crisis. Here is a 4-step forensic analysis you can apply to any potential investment. Step 1. Master the debt-to-equity ratio. This is the simplest and most powerful first-pass test of a company's financial health. It compares a company's total liabilities to its total shareholder equity. A high ratio indicates that the company has been aggressively financing its growth with debt. A low ratio signals a more conservative approach. As a rule for defensive investing, you should be looking for companies with a debt-to-equity ratio below 0.5. The true gems, the companies that are genuine financial fortresses, will often have more cash and short-term investments on their books than total debt. This is called a net cash position, and it's the gold standard of balance sheet strength. A company with net cash cannot go bankrupt from a creditor's call. It is financially invincible in the short term. Step 2. Scrutinize the current ratio. The current ratio, calculated as current assets divided by current liabilities, is a measure of a company's ability to meet its short-term obligations, those due within the next year. Current assets include things like cash, accounts receivable, and inventory. Current liabilities include accounts payable and the short-term portion of their debt. A ratio below 1 indicates that a company does not have enough liquid assets to cover its upcoming bills, a major red flag. For a truly resilient company, you want to see a current ratio well above 1.5 and ideally above 2. This provides a thick cushion of safety, ensuring that even if their revenues dip and their customers are slow to pay during a recession, they can easily weather the storm without needing to seek emergency financing. Step 3. Conduct a free cash flow audit. While not strictly a balance sheet item, a company's history of free cash flow generation is the best indicator of its future balance sheet strength. Go back at least 10 years and look at the company's statement of cash flows. Has it consistently generated positive free cash flow, year in and year out? Free cash flow is the engine that builds a strong balance sheet. It's the cash that can be used to pay down debt, build up a cash reserve, and return capital to shareholders. A company with a long, uninterrupted history of gushing free cash flow has proven its business model is both profitable and durable. It's a sign of a high-quality business that lives within its means. Step 4. Stress test the debt maturity profile. This is a more advanced step, but it's critically important. For a company that does have debt, you need to look in the footnotes of their annual report to find the debt maturity schedule. This table will show you how much of their debt is coming due each year for the next 5 years and beyond. The nightmare scenario is a company that has a huge wall of debt maturing in the next 1 or 2 years. If a recession hits at that exact moment, they will be forced to refinance that debt at much higher interest rates. Or worse, they may not be able to refinance it at all if credit markets are frozen. This is how seemingly healthy companies are suddenly pushed into bankruptcy. A company with a well-laddered debt profile, with small amounts of debt maturing each year over a long period, is far safer and more resilient. This forensic 4-step approach is the core of a sophisticated risk management process and is essential for anyone serious about asset allocation for wealth preservation. To fully grasp the power of this discipline, we must examine the antithesis, the seductive path of leveraged growth that the 99% of investors find irresistible. In a bull market, debt is seen as a magical tool. Why use your own slow, hard-earned cash to grow when you can borrow vast sums of money at low interest rates and turbocharge your expansion? The 99% are drawn to these stories like moths to a flame. They invest in companies that are engaged in a relentless, debt-fueled race for scale. Consider the shale oil boom in the early 2010s. With oil prices over $100 a barrel, companies borrowed billions upon billions of dollars to acquire land and drill new wells. Their stock prices soared. They were praised by Wall Street analysts for their aggressive growth strategies. Investors who piled in saw massive capital gains. They felt like geniuses. They ignored the astronomical debt levels on the balance sheets, assuming that high oil prices would last forever, a classic case of recency bias. When oil prices crashed in 2014–2015, the entire industry was decimated. The cash flow that was supposed to service that mountain of debt vanished. Dozens of these high-flying companies went bankrupt, and their shareholders were completely wiped out. The debt that was a tool for growth became an anchor that dragged them to the bottom of the sea. Another perfect example is the commercial real estate developer in the years leading up to 2008. They would borrow heavily to build speculative office towers and shopping malls, convinced that property values would only ever go up. Investors loved these companies for their rapidly growing asset bases and dividend yields that seemed too good to be true. But when the recession hit, tenants defaulted, vacancies soared, and property values plummeted. The developers were left with massive, empty buildings and interest payments they could no longer afford. The result was a wave of bankruptcies that vaporized investor capital. The common thread in these stories is the pursuit of growth at the expense of resilience. The 99% focus on the potential reward and systematically underestimate the potential risk. They forget that the person you are in business with is not just your partner or your customers, but also your banker. And the banker has to be paid back, in good times and in bad. A business that is beholden to its creditors is not in control of its own destiny. When a crisis hits, its decisions are no longer made by its management team in the best interest of shareholders, but by its lenders in the best interest of getting their money back. This often means forced asset sales, dilutive equity raises, or bankruptcy, all of which are catastrophic for existing shareholders. The path of the 99% is a high-wire act performed without a safety net, a strategy that works beautifully until the moment it leads to absolute ruin. The direct financial connection between a strong balance sheet and superior long-term returns is one of the most powerful forces in investing. It transforms a company from a fragile entity at the mercy of the economic cycle into a robust predator capable of thriving in chaos. Let's quantify this impact. First, consider the defensive benefits during a stock market crash. A company with high debt and falling earnings faces a lethal double whammy. As their earnings before interest and taxes, EBIT, decline, their interest coverage ratio, EBIT divided by interest expense, plummets. This is a key metric that credit rating agencies watch. A falling coverage ratio leads to credit downgrades. A credit downgrade increases the interest rate the company has to pay on any new or refinanced debt, further squeezing their profits and cash flow. It's a death spiral. Their stock price will collapse as investors price in the rising risk of bankruptcy. Now contrast this with a company in a net cash position. During a recession, its operating earnings might also dip, but it has no interest expense. In fact, its cash hoard is likely invested in short-term government bonds, generating interest income that actually cushions the fall in operating profits. Its balance sheet is a source of strength, not stress. Its stock becomes a safe haven, attracting capital and falling far less than the market average. But the real magic happens on the offensive side. The recession that cripples the leveraged competitor creates a once-in-a-decade opportunity for the company with the ironclad balance sheet. First, it can engage in aggressive share buybacks. With its own stock price depressed along with the rest of the market, it can use its cash to repurchase its own shares at incredibly attractive prices. This act of buying $1 of assets for 50 cents is a guaranteed way to create immense value for the remaining shareholders. Second, it can acquire struggling competitors for pennies on the dollar. Its highly leveraged rival, on the verge of bankruptcy, may be forced to sell its crown jewel assets at a fire sale price. The company with cash can step in and consolidate its industry, emerging from the recession with a larger market share and fewer competitors. This is how market leaders are forged. Finally, it can invest in its business for the long term. While competitors are firing staff and slashing research and development budgets just to conserve cash, the strong company can continue to invest in new technologies and projects, ensuring it emerges from the downturn with a significant competitive advantage. This ability to play offense when everyone else is playing defense is how a temporary market crisis is transformed into a permanent increase in a company's intrinsic value. For you as an investor, owning these financial fortresses means your portfolio not only survives the crash, but is positioned to compound capital at an accelerated rate during the subsequent recovery, a critical step on the path to lasting financial freedom. With a foundation built on the bedrock of inelastic consumer demand and fortified by the unbreachable walls of an ironclad balance sheet, we now add the third critical pillar to our all-weather portfolio, the regulatory moat. This is a more subtle yet profoundly powerful form of non-correlation. A regulatory moat exists when a company's profits, and often its very existence, are protected by the government. This protection can take many forms: licenses, patents, legally mandated service territories, or regulated pricing structures. These businesses are often insulated from the two greatest forces that destroy corporate profits: brutal competition and the devastating impact of economic cycles. They operate in a world apart, governed not by the chaotic whims of the market, but by the slow, predictable, and often legally binding logic of a regulatory framework. Investing in these companies is like owning a piece of essential economic infrastructure that has been granted a license to print money, year after year, with a level of certainty that is almost impossible to find in the free market. Understanding this pillar is key to adding a layer of unshakable stability and predictable income to your portfolio, a ballast that will keep your ship steady even in the most violent of storms. The foundational anecdote that best illuminates the power of a regulatory moat is not a quick, clever trade, but a slow, deliberate, and massive acquisition that reflects Buffett's mature investment philosophy, his purchase of the Burlington Northern Santa Fe (BNSF) Railroad in 2009. By this point, Buffett was no longer hunting for small, wonderful businesses like See's Candies. He was hunting for elephants, and BNSF was a behemoth. Berkshire Hathaway already owned a significant stake in the railroad, but in November 2009, with the world still reeling from the financial crisis, Buffett announced he was buying the rest of the company for a staggering $26 billion, making it the largest acquisition in Berkshire's history. On the surface, a railroad seems like the quintessential cyclical business. After all, it transports the goods that fuel the economy. When the economy booms, rail traffic is heavy. When it slumps, traffic declines. So why would Buffett make such a massive all-in bet on a seemingly cyclical industry? Because he saw past the short-term fluctuations in cargo volume and recognized the colossal, permanent regulatory moat that surrounds the entire North American railroad industry. You cannot simply decide to start a new railroad. The capital cost would be in the hundreds of billions, and more importantly, you would never be able to acquire the contiguous land rights needed to lay thousands of miles of track across the country. This creates an insurmountable barrier to entry. For most major long-haul routes in the United States, there are only two major railroad providers, creating a duopoly, or in some cases, a functional monopoly. This lack of competition gives railroads tremendous pricing power, but this power is checked and balanced by government regulation. The Surface Transportation Board sets the rules and oversees the rates railroads can charge, ensuring they can't price gouge their customers but are allowed to earn a fair return on the enormous capital they have invested in their networks. This creates a predictable, utility-like financial structure. Buffett saw BNSF not as a company that merely transports coal and grain, but as a permanent and essential artery of the American economy. He famously called the investment an all-in wager on the economic future of the United States. He knew that as long as the country grew over the long term, the demand for moving goods would grow with it, and BNSF, protected by its regulatory moat, would be there to capture a significant share of that growth with predictable, regulated profits. He wasn't betting on the next quarter or the next year. He was betting on the next century. The investment was a masterclass in long-term thinking and a profound understanding of how government-sanctioned moats create durable, non-correlated assets. The railroad doesn't care about the latest tech trend or consumer fad. It simply moves the fundamental building blocks of the economy, day in and day out, protected from competition by a moat of steel, land, and law. The psychological principle that prevents most investors from appreciating the power of regulatory moats is a combination of complexity bias and the lure of the new. Our brains are strangely wired to equate complexity with sophistication. We tend to believe that a convoluted, difficult-to-understand investment strategy must be superior to a simple one. The world of regulated industries, utilities, railroads, pipelines, waste management, is, on the surface, incredibly boring. Their business models are simple and have remained largely unchanged for decades. A utility generates electricity and sells it to a captive customer base at a price determined by a public commission. A railroad owns tracks and charges companies to move goods over them. There's no disruptive technology, no charismatic CEO promising to change the world, no exponential growth story. And because it's simple and boring, the average investor, driven by complexity bias, assumes it can't be a great investment. They are drawn instead to the intricate and exciting narratives of the tech world. They would rather try to understand the competitive dynamics of the cloud computing market or the future of artificial intelligence than read a utility's 100-page regulatory filing. They mistake complexity for opportunity and simplicity for stagnation. This bias is powerfully reinforced by the lure of the new. The financial media, and our culture at large, is obsessed with what's next. We celebrate the innovators, the disruptors, the companies that are creating the future. There are no breathless news reports about a utility commission approving a 3% rate increase for a power company. The headlines are dominated by product launches from Apple, battery innovations from Tesla, or the latest IPO of a social media app. This constant bombardment of novelty creates a powerful availability heuristic. Our minds give more weight to things that are easily recalled, and exciting, newsworthy events are far more memorable than the slow, steady compounding of a boring, regulated business. Buffett's genius is his ability to completely invert this psychological framework. He understands that in the world of long-term investing, predictability is far more valuable than excitement. He actively seeks out simplicity because it allows him to understand a business's long-term economics with a much higher degree of certainty. He is not trying to predict the winner of a hyper-competitive, fast-changing technology race. He is trying to find a business that will almost certainly be larger and more profitable in 10 or 20 years. A regulated utility or a duopoly railroad fits that description perfectly. The psychological comfort of owning an asset whose returns are, to a large extent, underwritten by law is immense. It allows an investor to ignore the market's manic depressive swings and focus on the slow, inevitable accumulation of value. It's a deliberate choice to trade the thrill of the new for the certainty of the necessary, a core tenet of advanced portfolio diversification. So how can you systematically identify these bastions of stability for your own all-weather portfolio? The blueprint for finding businesses with strong regulatory moats involves looking for sectors where the government has intentionally limited competition to ensure the delivery of an essential service. Here is a 4-step model to guide your search. Step 1. Hunt for essential, capital-intensive infrastructure. Start by thinking about the absolute bedrock services of a modern economy. What are the things that society cannot function without? The electricity grid, the water and sewer systems, the natural gas pipelines, the freight rail network, and the airports. These services typically have two things in common. They are absolutely essential, and they require mind-boggling amounts of capital to build and maintain. Because of this, it makes no economic sense to have multiple, competing electricity grids or water systems in the same city. The government recognizes this, and, in exchange for private companies investing the massive capital required, it grants them a monopoly or a duopoly in a specific service area. Your task is to identify the public companies that own and operate this critical infrastructure. Step 2. Analyze the specific regulatory environment. Not all regulatory frameworks are created equal. The gold standard for an investor is a cost-plus or rate of return model, which is common for electric and water utilities. In this model, the company goes before a Public Utility Commission, PUC, and presents its costs and the capital it has invested in its infrastructure, its rate base. The PUC then allows the company to set prices, rates, for consumers that cover its costs. Tax plus allow it to earn a specific regulated return on its equity, often in the 9 to 11% range. This is an incredibly powerful setup. The company is essentially guaranteed a reasonable profit by law. When you're researching a utility, you need to understand the regulatory environment in the states where it operates. Is the PUC generally seen as fair and constructive, or is it hostile and political? A stable, predictable regulatory environment is the key to a strong moat. Step 3. Confirm the high barriers to entry. The regulatory protection is often just one layer of the moat. Look for other, reinforcing barriers. For railroads, it's the physical impossibility of acquiring the land. For waste management companies like Waste Management or Republic Services, it's the incredibly difficult and lengthy process of getting environmental permits to build and operate new landfills. These landfills become quasi-monopolies in their regions. For pharmaceutical companies, the moat is the patent system, a government-granted 20-year monopoly on a new drug they have developed. For a broadcast television company, it's the limited number of broadcast licenses issued by the FCC. Always ask, what prevents a new, well-funded competitor from entering this market? If the answer is a law or a physical impossibility, you've likely found a powerful moat. Step 4. Look for a history of predictable cash flows and dividends. The financial signature of a company with a strong regulatory moat is consistency. Because their revenues are stable and their profits are regulated, these companies tend to be cash-generating machines. They don't need to retain vast sums of cash for cutthroat competitive battles or massive R&D spending on speculative projects. As a result, they often pay out a large percentage of their earnings to shareholders in the form of dividends. Look for a long, uninterrupted history of paying, and ideally steadily increasing the dividend. This is the ultimate proof that the moat is real and that management is focused on returning capital to its owners. A consistent dividend history is a hallmark of the kind of boring, predictable business that forms the unshakable core of a defensive investing strategy. To truly value the serene predictability of a regulated business, we must confront the antithesis, the brutal, cash-burning reality of hyper-competitive, unregulated markets. This is where the 99% of investors flock, drawn by the siren song of explosive growth, completely oblivious to the destructive economics of these red ocean industries. A red ocean, a term coined by W. Chan Kim and Renee Mauborgne, is an industry where companies tear each other apart to grab a greater share of existing demand. The competition is fierce, the water is bloody, and profit margins are constantly under assault. Think of the dozens of food delivery apps that emerged in the last decade. Grubhub, Uber Eats, DoorDash, all offering the same basic service, all locked in a desperate war for customers and restaurants. Their primary weapon? Price. They burn billions of dollars in venture capital, subsidizing deliveries, and offering endless promotional discounts, all in a frantic attempt to gain market share. In a recession, this model implodes. Discretionary spending on restaurant delivery plummets. The endless supply of dumb money from venture capitalists dries up. These companies, having never achieved sustainable profitability, face a brutal reckoning. The weakest players go bankrupt, and even the survivors are left with deep financial scars. Contrast this with a regulated water utility. Its customers cannot switch to a competitor. Its prices are set by a commission to ensure its profitability. A recession has almost zero impact on its business model. Another example is the tidal wave of electric vehicle startups. For every Tesla, there are dozens of other companies, Rivian, Lucid, Fisker, all vying for a piece of the same market. They're engaged in a massively capital-intensive battle, spending billions on factory construction and battery technology, all while facing intense competition from the established global automakers who are also pouring billions into EVs. This is a red ocean of epic proportions. Who will win is anyone's guess. Many will undoubtedly fail, wiping out their shareholders in the process. The 99% invest in these industries because they are exciting and newsworthy. They are betting on picking the one winner in a field of dozens. This is not investing, it is speculation. They are ignoring one of the most fundamental laws of business. When too much capital chases the same opportunity, the returns are competed away. They are choosing to invest in a chaotic, unpredictable war zone, while completely ignoring the peaceful, profitable, and protected kingdoms created by regulatory moats. This strategic error is a primary reason why most portfolios are so fragile and so susceptible to being destroyed by the first wave of an economic downturn. The direct financial connection between a regulatory moat and your portfolio's resilience is profound and quantifiable. It manifests as lower volatility, reliable income, and a powerful defense against inflation. Let's break down the numbers. First, consider the impact on volatility, often measured by a stock's beta. Beta measures how much a stock's price moves in relation to the overall market. The market has a beta of 1.0. A stock with a beta of 1.5 is 50% more volatile than the market, while a stock with a beta of 0.5 is 50% less volatile. Regulated utilities and infrastructure companies consistently have betas well below 1.0, often in the 0.4 to 0.6 range. This means that if the S&P 500 falls by 20% during a correction, a low beta utility stock might only fall by 8% to 12%. This provides a huge amount of ballast to a portfolio. It acts as a shock absorber, smoothing out the returns and dramatically reducing the painful drawdowns that cause investors to panic and sell. This is a critical component of building an all-weather portfolio. Second, the financial connection is through reliable, growing income. Because of their stable, regulated cash flows, these companies are paragons of dividend consistency. Companies in the Dividend Aristocrats Index, S&P 500 companies that have increased their dividend for at least 25 consecutive years, are disproportionately from regulated or moated industries. This dividend stream is a powerful source of total return. During a flat or down market where capital gains are absent, a 3 to 4% dividend yield might represent your entire return. Furthermore, this income provides you with dry powder. The cash from these dividends can be automatically reinvested, buying more shares at lower prices during a downturn, a process known as dollar-cost averaging, or it can be accumulated and deployed opportunistically into more beaten-down sectors of the market. Finally, many regulatory moats provide an explicit defense against inflation. In a cost-plus regulatory model, when a utility's costs for things like fuel or labor go up due to inflation, it can go to the Commission and request a rate increase to pass those higher costs directly on to consumers. Its profit margin is protected. This is a rare and valuable characteristic. Most non-regulated businesses have to absorb rising costs, which erodes their profitability. For a long-term investor concerned about wealth preservation, owning assets that have a built-in inflation hedge is a crucial and sophisticated strategic move. In essence, the financial contribution of a regulatory moat is certainty. In a world of radical uncertainty, owning a business whose profits are backstopped by law provides a level of peace of mind and financial stability that is simply unattainable in the hyper-competitive free market. It is the anchor that allows the rest of your portfolio to weather any storm. We have now constructed a portfolio with a core of businesses serving unchanging human needs and financed by fortress-like balance sheets, all while being protected by the formidable power of regulatory moats. But there is another category of recession-proof businesses, one that Wall Street and the financial media almost completely ignore, precisely because it is so effective. This brings us to our fourth pillar, the boring is beautiful doctrine. This is the art of investing in the unsexy, the mundane, the overlooked. These are the companies that operate in the shadows of the market, quietly and efficiently executing simple business models that have worked for decades. They make the nuts and bolts, collect the trash, sell the industrial lubricants, and manufacture the cardboard boxes. They will never be the subject of a fawning magazine cover story. Their CEOs are not celebrities. They do not hold splashy product launches, and in their profound dullness lies their immense strength. Because they are ignored by the hype machine, they are often systematically undervalued. And because their businesses are based on simple, essential products and services with low rates of change, they are remarkably resilient to economic shocks and technological disruption. Embracing the boring is beautiful doctrine is a conscious act of rebellion against the market's obsession with excitement, and it is a powerful secret weapon for building a truly robust, all-weather portfolio. To understand the beauty of boring, we must travel back to Omaha in 1983 and learn about one of Warren Buffett's most cherished investments, one that perfectly embodies this philosophy. This is the story of Nebraska Furniture Mart and its founder, Rose Blumkin, a woman Buffett simply called Mrs. B. Mrs. B was a Russian immigrant who fled to the United States in 1917. She couldn't read or write English, but she had an indomitable will and a simple, powerful business idea. In 1937, she borrowed $500 from her brother to start a furniture store in the basement of her husband's shop in Omaha. Her strategy was radical in its simplicity: sell cheap and tell the truth. She would buy furniture in bulk, operate with razor-thin margins, and pass the savings on to her customers. She worked from sunup to sundown, building her business through sheer force of will and a fanatical devotion to her customers. She famously had no time for slick salesmen or fancy displays. Her store was a no-frills warehouse, piled high with merchandise. Her competitive advantage was not a patent or a brand in the traditional sense. It was a reputation for offering the absolute lowest prices, period. By the early 1980s, Nebraska Furniture Mart was a local legend, a single-store operation that was generating an astonishing $60 million in annual sales and dominating the Midwest furniture market. Competing stores across the region had gone out of business, unable to compete with Mrs. B's brutally efficient, low-cost model. Warren Buffett had been watching her for decades. He saw a business that was utterly simple, completely unsexy, and phenomenally successful. It wasn't a tech company. It wasn't a global brand. It was a furniture store. But it was the best furniture store in the world. In 1983, Buffett went to meet the then 89-year-old Mrs. B. He didn't come with an army of lawyers and accountants. He asked her a few questions, and then he made her an offer. He wanted to buy 90% of her business. He asked her how much she thought it was worth. She named a price, around $55 million. Buffett agreed on the spot. He wrote a check. He didn't even ask for an audit of the books. The deal was sealed with a simple handshake. Why would Buffett do this? Because he recognized that the value of Nebraska Furniture Mart wasn't in its physical assets. It was in the boring, unglamorous but incredibly powerful business model that Mrs. B had perfected over 50 years. It was a business with a moat built not of patents or regulations, but of a fanatical culture of low-cost operations and customer trust. It was a model that was inherently recession-proof. During tough economic times, customers become even more price-sensitive. They don't stop buying furniture altogether. People still get married, have children, and need a place to sleep, but they flock to the place that offers the best value. Nebraska Furniture Mart's business actually got stronger during downturns. The acquisition was a testament to Buffett's belief that a simple, durable, and brilliantly managed boring business can be one of the most valuable and resilient assets an investor can own. The psychological forces that cause the vast majority of investors to overlook gems like Nebraska Furniture Mart are the availability heuristic and herd mentality. These two cognitive biases work in tandem to create a powerful focus on a very narrow slice of the stock market: the exciting, the newsworthy, and the popular, while rendering the vast universe of boring businesses effectively invisible. The availability heuristic, as we've touched on, is our mental shortcut of judging the likelihood of an event by how easily examples come to mind. The companies that are constantly in the news, the Apples, the Teslas, the Amazons, are always at the front of our minds. When an investor thinks, "What stock should I buy?" these are the names that are immediately available for consideration. A company that manufactures industrial fasteners or provides commercial cleaning services never makes the headlines. It has zero mental availability. Therefore, to the average investor, it might as well not exist. This creates a massive, systemic undervaluation of boring companies. Because they aren't on anyone's radar, there is less demand for their stock, which often keeps their prices reasonable and their valuations attractive. Herd mentality is the natural human instinct to follow the actions of a larger group. It's a survival mechanism left over from our evolutionary past. It was safer to stay with the tribe. In investing, this manifests as a powerful urge to buy what everyone else is buying. When a stock is soaring and is the talk of the town, the fear of missing out, FOMO, becomes overwhelming. Investors pile in, not because they've done a deep analysis of the business, but because everyone else is doing it and they don't want to be left behind. This creates speculative bubbles in story stocks, while simultaneously creating a vacuum of interest around stable, boring businesses. Buffett's entire career can be seen as a conscious and deliberate war against these two biases. He actively seeks out the neglected corners of the market. He famously said, "You pay a very high price in the stock market for a cheery consensus." He understands that the best investment opportunities are often found in the businesses that no one else is talking about. He exploits the market's obsession with excitement by focusing on the predictable cash flows of the mundane. It requires a rare form of psychological discipline. It means being comfortable with owning a portfolio that you can't brag about at a cocktail party. It means choosing the quiet compounding of a waste management company over the thrilling roller coaster of a biotech startup. It is a commitment to substance over story, a philosophy that is deeply contrarian and spectacularly effective for long-term wealth preservation. How, then, do you develop the mindset and the process to systematically uncover these hidden champions? The blueprint for applying the boring is beautiful doctrine requires you to become a financial detective looking for clues of quiet quality where no one else is bothering to look. Here is a 4-step mental model for your stock picking process. Step 1. Apply the yawn test. This is a simple but highly effective initial screen. When you are researching a company, try to explain its business model to a friend or family member in 1 or 2 sentences. If their eyes glaze over and they start to yawn, you may have found a winner. This company makes the adhesive labels for food packaging. Yawn. This company is the largest producer of industrial-grade salt used for de-icing roads. Double yawn. This company operates a network of rock quarries to provide crushed stone for construction projects. You get the idea. The more mundane and essential the business, the less likely it is to attract the attention of the speculative herd, and the more likely it is to have a stable, predictable business model with little competition. Step 2. Screen for industries with a low rate of change. The enemy of long-term investment returns is rapid, unpredictable change. You want to find businesses that operate in industries where the core product or service is likely to be the same in 20 years as it is today. People will still be drinking beer, eating candy, needing insurance, and throwing away trash in 2050. The competitive landscape in these industries is often stable and well-established. Contrast this with a fast-changing industry like social media or consumer electronics, where the dominant company from a decade ago can be irrelevant today. A low rate of change means a business's competitive advantages are more likely to be durable, and its future earnings are far more predictable. Step 3. Hunt for quiet compounders. Once you've identified a boring industry, look for the financial signatures of a high-quality, shareholder-friendly business. These companies are often characterized by high levels of insider ownership. Management owns a significant chunk of the stock, so their interests are aligned with yours. They have a long history of consistent profitability and a pristine balance sheet with little or no debt. Most importantly, they have a track record of being smart capital allocators, steadily using their free cash flow to increase their dividend, buy back their own stock, and make small, sensible acquisitions. They aren't trying to hit home runs. They are just hitting singles and doubles, year after year, quietly compounding your wealth. Step 4. Focus on gross profit margin. This is a powerful and often overlooked financial metric. Gross profit margin, calculated as revenue minus cost of goods sold divided by revenue, reveals a company's basic profitability before all the corporate overhead. In a seemingly boring commoditized industry, a company that consistently earns a much higher gross margin than its competitors is a huge red flag, a positive one. It signals that the company has some kind of hidden competitive advantage. It might be a low-cost production process, a superior distribution network, or a niche brand that commands a premium price. This high gross margin is the numerical proof of a moat in a business that, on the surface, appears to have none. Following this 4-step process is a powerful way to filter out the market noise and focus on the kind of durable, high-quality businesses that form the core of a resilient, all-weather portfolio. To fully appreciate the wisdom of this path, we must examine its antithesis, the path of the 99%, which is the obsessive chasing of story stocks. A story stock is a company, typically in a hot sector like technology or biotech, that has a grand, world-changing vision but often has little to no current profits or cash flow. The investment thesis is based not on the company's current reality, but on a narrative about its future potential. In a bull market, these stories are incredibly seductive. Investors are captivated by the charisma of the founding CEO, the promise of a total addressable market worth trillions, and the idea of getting in on the ground floor of the next Amazon. They buy the stock based on hope and hype, often at valuations that are completely detached from any financial fundamentals. The SPAC, Special Purpose Acquisition Company boom of 2020 and 2021 was the ultimate expression of this phenomenon. Billions of dollars poured into blank check companies that had no operations, just a promise to merge with a private, often unprofitable future of company, the future of electric flight, the future of space travel, the future of online gambling. The stories were amazing. The financial reality was often horrific. When the market cycle turned and investors began to demand profits instead of promises, the vast majority of these story stocks collapsed, with many falling over 90% from their peaks. The capital destruction was immense. The 99% are drawn to story stocks because it feels like they are participating in the future. It's exciting. It makes them feel smart and forward-thinking. But they are making a critical mistake. They are confusing a good story with a good investment. A great narrative does not guarantee a great business. More often than not, a visionary product or technology does not translate into durable profits for shareholders. The early history of automobiles, airlines, and televisions is a graveyard of bankrupt companies that had revolutionary products but terrible business models. The 99% focus on the story. The disciplined, boring investor focuses on the financial statements. They know that a compelling narrative can vanish overnight when the economic weather changes, but a long history of consistent cash flow is a fortress that can withstand any storm. The path of the 99% is a portfolio built on sand, a collection of exciting but fragile dreams that are destined to be washed away by the first tide of a recession. The direct financial connection of the boring is beautiful doctrine is a powerful combination of valuation advantage and business model resilience that creates superior risk-adjusted returns over the long term. Let's quantify how this works for your portfolio. First is the valuation advantage. Because boring companies are systematically ignored by the market's hype machine, their stocks often trade at a significant discount to the broader market and especially to exciting growth stocks. It's not uncommon to find a quiet compounder trading at a price-to-earnings (PE) ratio of 12 to 15, while the story stock of the day trades at 50 times sales, not even earnings. This lower starting valuation provides a powerful margin of safety, a concept coined by Benjamin Graham. It means you have less downside risk, as the stock is already priced for low expectations. It also provides greater upside potential. As the company continues to steadily grow its earnings, its stock price can rise from both the earnings growth itself and from a potential increase in its valuation multiple, as the market eventually recognizes its quality. This double-barreled return is a key driver of long-term wealth creation. The second financial connection is the resilience of the business model. Let's compare the income statement of a boring company like Waste Management with a story stock during a recession. Waste Management's revenue is incredibly stable. People and businesses produce trash in good times and in bad. It's a non-discretionary service with long-term contracts. Their margins are predictable, and they convert a high percentage of their earnings into free cash flow. A story stock, on the other hand, might have explosive revenue growth during a boom but is often burning cash to achieve it. Its business model is unproven and fragile. In a recession, its revenue growth can screech to a halt or even reverse, and its access to the capital markets to fund its losses can be cut off. This is a recipe for disaster. On the balance sheet, the difference is just as stark. The boring company will typically have a conservative capital structure with manageable debt. The story stock is often loaded with debt or has been rapidly diluting its shareholders by issuing new stock to fund its operations. This financial strength allows the boring company to be opportunistic during a downturn. It can continue to pay and raise its dividend, buy back its stock at depressed prices, and acquire weaker competitors. It exits the recession stronger than it entered. The story stock is simply in survival mode, if it survives at all. For your portfolio, owning a collection of these boring, high-quality businesses provides a powerful anchor of stability and a source of quiet, relentless compounding, ensuring that your journey towards financial freedom is a steady march, not a speculative gamble. We have now assembled a formidable portfolio. It is anchored in businesses that serve inelastic demands, built upon ironclad balance sheets, protected by regulatory moats, and populated by the quietly brilliant, boring compounders that Wall Street ignores. This is a fortress designed for defense, for wealth preservation. But the final pillar, the most advanced and opportunistic of all, turns this fortress into a vehicle for attack. This is the fifth pillar, the counter-cyclical predator. This is the strategy of not just surviving a recession but actively profiting from it. It involves identifying and owning a specific class of businesses whose fortunes are inversely correlated with the broader economy. These are the companies that thrive when times are tough, that see their sales and market share grow as consumers become more price-conscious and financially stressed. Owning these assets is the ultimate form of portfolio diversification. They provide a natural hedge, a source of green in a sea of red. More importantly, they generate the cash flow and the psychological fortitude required to go on the offensive, to buy the world-class cyclical businesses that are being sold for pennies on the dollar during a market panic. This is the final key that transforms a stock market crash from a terrifying threat into the single greatest wealth-building opportunity of your lifetime. While Warren Buffett's most famous crisis-era investments were in bailing out giants like Goldman Sachs, the underlying principle of counter-cyclical investing is deeply embedded in the DNA of Berkshire Hathaway's operating businesses. A perfect foundational anecdote to illustrate this is the nature of one of Berkshire's largest subsidiaries, Geico. Buffett's love affair with Geico began when he was just a student at Columbia University. He took a train to Washington, D.C. on a Saturday and knocked on the door of their headquarters until a janitor let him in. He ended up spending hours talking to a senior executive, Lorimer Davidson, and came away convinced that Geico's business model was brilliant. What was that model? Geico, the government employees' insurance company, had a massive cost advantage. By marketing directly to consumers and targeting a low-risk pool of government employees, it could offer auto insurance at a significant discount to its competitors who used expensive agent networks. Buffett saw this as a simple, powerful, and durable moat. But there is a deeper, counter-cyclical beauty to the auto insurance business that he came to appreciate. Auto insurance is not a discretionary purchase. It is legally mandated in nearly every state. You cannot drive a car without it. This creates a baseline of demand that is completely disconnected from the economic cycle. Whether the GDP is growing at 4% or shrinking at 2%, people still need to drive to work, to the store, and to school, and they must have insurance to do so. The premiums Geico collects are a steady, predictable stream of cash, month after month, regardless of the economic weather. But the model is even better than that. During a recession, the business actually gets stronger in two ways. First, consumers become intensely price-sensitive. They start looking for ways to cut their monthly bills. The family that was happy with their local high-cost State Farm agent during the boom years now starts actively shopping around for a better deal. They are drawn to the low-cost providers. Geico's low-cost model becomes a more powerful competitive advantage during a downturn, allowing it to aggressively gain market share from its higher-cost rivals. Second, the business becomes more profitable on the claims side. During a recession, people tend to drive less. They take fewer long road trips, and unemployed individuals are no longer commuting to work. Fewer miles driven means fewer accidents, and fewer accidents mean lower claim payouts for Geico. So at the exact moment when most businesses are seeing their revenues fall and their costs rise, a well-run insurer like Geico can see stable or growing revenues from new customers and falling costs from lower claims. It is a business model that is structurally designed to thrive in adversity. While Buffett's initial purchase of Geico stock was in the 1950s and he took full control of the company in the 1990s, the enduring logic of its counter-cyclical nature is a pillar of Berkshire's incredible financial stability. It is a cash-generating machine that works in all seasons, but works best when the economic storms are raging. The psychological principle that underpins the strategy of a counter-cyclical predator is the mastery of loss aversion and the weaponization of panic. Loss aversion is one of the most powerful and well-documented biases in behavioral finance. Studies by psychologists Daniel Kahneman and Amos Tversky have shown that the pain of losing a dollar is psychologically about twice as powerful as the pleasure of gaining a dollar. This is an evolutionary defense mechanism. For our ancestors, losing their food supply was a far more significant event than finding a little extra. In investing, this manifests as an intense, visceral fear during a market downturn. As an investor watches their portfolio value shrink, the pain becomes overwhelming. This triggers the primitive fight-or-flight response. The instinct is to make the pain stop, and the only way to do that is to sell. This leads to panic selling, where investors liquidate their holdings at the worst possible time, locking in their losses. The average investor's portfolio is pro-cyclical. It is filled with stocks that do well when the economy is good. When a recession hits, everything turns red at once. Every stock is a source of pain. There is no psychological anchor, no safe harbor within the portfolio to provide a sense of stability. This amplifies the feeling of panic and makes capitulation almost inevitable. The counter-cyclical investor, however, has engineered their portfolio to neutralize this very bias. By deliberately allocating a portion of their capital to counter-cyclical assets, like a discount retailer or a low-cost insurer, they create a psychological ballast. When the market is crashing and their cyclical stocks are down 30 or 40%, they can look at their portfolio and see a green shoot. They see their discount retailer stock is actually up 10%. This is an incredibly powerful psychological circuit breaker. It provides tangible evidence that their strategy is working. It short-circuits the panic response and allows their rational, analytical brain to remain in control. They are not just losing money, they are also making money. This stability allows them to move to the next predatory step, weaponizing the panic of others. Because they are not panicking, they can calmly observe the market and see the incredible bargains being created by the forced selling of the loss-averse herd. They can then take the profits or dividends being generated by their thriving counter-cyclical assets and redeploy that capital, buying the world-class but temporarily hated cyclical companies at absurdly low prices. This is the ultimate form of financial arbitrage, converting the market's irrational fear into your own rational, long-term gain. It is a strategy that is as much about mastering your own psychology as it is about mastering financial analysis. So how do you build this offensive capability into your own portfolio? The blueprint for integrating counter-cyclical assets is a strategic form of asset allocation designed to create an internal hedge that works when you need it most. This is not about market timing, but about permanent portfolio construction. Here is a 4-step model to identify and allocate to these predators. Step 1. Identify the trade-down businesses. This is the largest and most intuitive category of counter-cyclical stocks. During a recession, as household incomes are squeezed, a massive behavioral shift occurs. Consumers trade down. They stop shopping at high-end grocery stores and flock to discount retailers like Walmart, Costco, and Dollar General. They stop buying new cars and instead spend money fixing their old ones, which benefits DIY auto parts stores like AutoZone or O'Reilly Automotive. They forego expensive restaurant meals in favor of cooking at home, which benefits low-cost food producers and generic brand manufacturers. Your task is to identify the public companies that are the primary beneficiaries of this trade-down effect. Ask yourself, when people have less money, where do they go to buy essential goods? Step 2. Consider the inescapable vices or sin stocks. Historically, certain industries have proven to be remarkably recession-resistant because their products cater to human habits and addictions that are not curtailed during economic stress. These are the producers of alcohol and tobacco. In fact, some studies suggest that consumption of these goods can even increase during stressful economic times. While there may be ethical considerations for some investors from a purely financial perspective, companies like Altria, Tobacco, or Diageo, the world's largest spirits company, have demonstrated incredibly stable cash flows through multiple recessions. Their inelastic demand is driven by the powerful force of addiction, making them a potent, albeit controversial, form of defensive investing. Step 3. Look for the vulture industries. This is a more direct and cynical way to profit from economic distress. Certain businesses see their revenues directly increase as a result of others' failures. These include debt collection agencies, which have more delinquent accounts to pursue during a recession. They include bankruptcy law firms and corporate restructuring advisors, whose services are in high demand when companies are struggling. Another example is the pawn shop industry, where companies like EZ Corp see an increase in business as people need short-term loans and are forced to sell their possessions for cash. These are businesses that directly feed on economic downturns, providing a powerful, though sometimes grim, counter-cyclical hedge. Step 4. Implement a strategic allocation. Counter-cyclical assets should not dominate your portfolio. They are a strategic tool, not the entire toolbox. A well-diversified all-weather portfolio might have a permanent strategic allocation of 10% to 20% in a basket of these counter-cyclical businesses. This is not a trade you put on when you think a recession is coming. It's a permanent feature of your portfolio architecture. In a roaring bull market, this part of your portfolio will likely underperform, and that's okay. Its job is not to maximize gains during the good times. Its job is to provide stability, cash flow, and psychological comfort during the bad times, giving you the resources and the courage to act when the real opportunities appear. The antithesis to this sophisticated hedged approach is the portfolio construction method used by the 99% of investors, the purely pro-cyclical portfolio. This is a portfolio that is perfectly designed to capture the upside of a booming economy, and as a result is perfectly designed to be annihilated by a recession. The pro-cyclical portfolio is loaded with the darlings of a bull market. It's heavily weighted towards the consumer discretionary sector, companies that sell the wants, not the needs, the new cars, the vacations, the luxury goods, the restaurant meals. It's overweight the technology sector, particularly the high-growth, high-beta names, whose valuations are dependent on a narrative of uninterrupted future growth. It's filled with financial stocks like banks, whose profitability is directly tied to loan growth and a healthy economy. And it has a heavy dose of industrial companies that sell heavy machinery and equipment, whose orders evaporate when businesses stop expanding. In a bull market, this portfolio is a rocket ship. The investor feels like a genius as every single one of their positions goes up in unison. They are being rewarded for taking on maximum cyclical risk. The problem is, they don't perceive it as risk. They perceive it as being invested in the best, most dynamic parts of the economy. They have created a portfolio with an internal correlation of 1.0. All of their stocks are dancing to the same economic music. When the music stops, they all fall down at the same time. There is no internal hedge. There is no source of strength. There is no green shoot to provide psychological comfort. Every line item in their brokerage account is a sea of crimson. This is the exact setup that triggers panic. The pain is universal across their holdings. Their beautifully designed rocket ship transforms into a stone, and the instinct to hit the eject button becomes irresistible. They sell everything, often near the bottom, just to make the pain stop. The path of the 99% is not a conscious choice to build a fragile portfolio. It is the subconscious result of chasing what's popular and performing well right now. It is the result of recency bias and herd mentality. It is a failure to appreciate that the primary goal of portfolio construction is not to maximize gains in any given year, but to build a structure that can survive and thrive over a full market cycle, encompassing both the inevitable boom and the inevitable bust. The direct financial connection of integrating counter-cyclical assets is the ultimate transformation of your portfolio's risk profile. It moves you from being a passive victim of the market cycle to an active and opportunistic participant. Let's quantify this transformation. First, look at the impact on portfolio drawdown. A standard pro-cyclical 100% equity portfolio might experience a 50% peak-to-trough drawdown during a severe recession like 2008. This means a $1 million portfolio would shrink to $500,000. To recover, it needs to generate a 100% return from the bottom, a monumental task. A portfolio with a 20% strategic allocation to counter-cyclical assets that, let's say, rise 10% during the crash, while the other 80% falls 50%, would have a much smaller drawdown. The $800K in cyclical assets would fall to $400K, while the $200K in counter-cyclical assets would grow to $220K. The total portfolio value would fall from $1 million to $620,000, a drawdown of only 38%. This smaller drawdown is mathematically and psychologically easier to recover from. More importantly, it provides a source of capital. The investor can now rebalance the portfolio. They can sell a portion of their now overweighted countercyclical winners, the 220K, and use that cash to buy more of the beaten-down cyclical assets at bargain prices. They are systematically selling high and buying low, a forced discipline that is the exact opposite of the panic selling practiced by the 99%. Let's look at a real-world example. During the 2008 financial crisis, from the peak in late 2007 to the bottom in early 2009, the S&P 500 lost over 50% of its value. During that same period, the stock of Walmart, WMT, the ultimate trade-down beneficiary, was actually trading up about 20%. Imagine an investor in 2007 with two portfolios. One is 100% in an S&P 500 index fund. The other is 80% in the index and 20% in Walmart. By March 2009, the first investor's portfolio was cut in half. The second investor's portfolio was down, but significantly less, and they had a major winning position that they could use as a source of funds to buy the rest of the market at generational lows. This is not a theoretical exercise. This is the practical, real-world application of building a truly resilient, opportunistic, all-weather portfolio. It is the final and most powerful piece of the puzzle, the mechanism that allows you to turn the market's greatest fear into your greatest advantage on the road to lasting financial freedom. You have just absorbed a complete blueprint for financial resilience. You have moved beyond the simple, often misleading advice about diversification and learned the deep, fundamental principles that separate the amateur from the professional. You've learned to build a portfolio around the fortress of inelastic demand, ensuring your assets are tied to enduring human needs, not fleeting economic trends. You've learned to demand the safety of an ironclad balance sheet, transforming your companies from fragile dependents into opportunistic predators. You've seen the power of the regulatory moat, an anchor of legal certainty in a chaotic world. You've embraced the boring is beautiful doctrine, exploiting the market's obsession with hype to acquire quality assets at reasonable prices. And finally, you've learned to arm your portfolio with counter-cyclical predators, turning the terror of a market crash into a strategic opportunity. This is not just a collection of tips. It is a comprehensive mental model, a new operating system for viewing the world of investing and risk management. You have acquired the tools to build a financial structure that can not only withstand the inevitable storms, but harness their energy for your own long-term benefit. But mastering this architecture, knowing what to buy, is only one half of the equation. The most perfectly designed system is useless without the will and the temperament to execute it under pressure. Building this portfolio is an act of reason, but holding it through a crisis is an act of profound emotional courage. The greatest challenge is not financial analysis, it is mastering the psychology of fear and greed that derails 99% of investors. The principles you have just learned are your shield, but your mind is the warrior who must wield it. And that warrior must be trained. A system of knowledge is only as strong as the psychological foundation upon which it is built. You have the map, but the journey through the storm requires an internal compass, a set of mental models designed not for picking stocks, but for controlling the one variable that truly matters: your own behavior when the world is screaming at you to panic. The video that is now appearing on your screen is not just another piece of content, it is the other half of the equation. It is the bridge between this knowledge and its successful application. It is the missing link that connects the strategic blueprint to the psychological fortitude required to execute it. This system of asset allocation and the system of emotional control are two parts of a single, powerful machine for wealth creation. One cannot function without the other. What you have just learned is the what. The video on your screen is the how. It is the key to forging the temperament of an elite decision-maker, the final piece of the mental arsenal that separates those who merely survive the market from those who come to command it. Average investors spend their time collecting information and chasing hot tips. True wealth builders spend their time constructing a complete, unbreakable system of both knowledge and discipline. The choice to complete that system, to forge that final link in the chain that leads to true and lasting financial freedom, is yours. If you are serious about that ascent, you know exactly what to do.